Hey everyone, welcome back to Corporate Decoder. Today FATN just filed a Form 8 announcing an at-the-market offering, and I'm seeing a move here that could signal something brewing for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details how FatPipe is planning to raise up to $10 million by selling its stock little by little, and it's a move that often comes with its own set of risks and rewards for shareholders. So FatPipe Inc. is a technology company specifically in the software infrastructure space. They recently stayed in the Russell Microcap Index, which is a small positive for visibility. We've also seen some analysts raising their price targets for the stock earlier this year, anticipating some good performance. And importantly, in March we saw a director, Regular Bhaskar, buy a pretty decent chunk of stock, which can sometimes be a bullish sign from insiders. The company's common stock is traded on the Nasdaq capital market under the ticker symbol FATN. As of now, the market cap is around $84 million with a P/E ratio of about 17. That's not too shabby for a tech company. Their stock has been trading in a range from about $1.31 up to $10.7 over the past year, and its current price is around $5.98. They have about 172 employees. Now to the filing itself. On the 2nd of July 2026, FatPipe announced they entered into an at-the-market sales agreement with H.C. Wainwright and Company LLC. This is often called an ATM offering. This agreement allows FatPipe to sell shares of its common stock from time to time, up to a total of $10 million. Think of it like this: the company can decide to sell small batches of its stock whenever it feels the price is right or when it needs cash. The shares they are selling are their common stock. The trading symbol for their common stock is FATN, and it is traded on the Nasdaq capital market. FatPipe has also elected to be an emerging growth company, which means they get some regulatory flexibility. They've also chosen not to delay adopting new accounting standards, which shows a commitment to current financial reporting. This section, Item 1.01, tells us about the official partnership they've struck to make these sales happen. The core of this filing is this sales agreement. FatPipe can now go to H.C. Wainwright, who will act as a sales agent or sometimes buy the stock outright to resell it. The total amount they can raise through this program is $10 million. This is a significant amount for a company with an $84 million market cap. Wainwright will get a commission of 3% on any sales made through this agreement. That means for every dollar of stock sold, FatPipe keeps 97 cents. These sales will happen through what are called at-the-market offerings. This is a common way for public companies to raise capital without needing to do a big traditional stock offering that can sometimes flood the market and depress the stock price. It is important to note that FatPipe doesn't have to sell any shares if they don't want to. They can pause or stop the program whenever they choose. This gives them a lot of flexibility. The shares being sold will be covered under a shelf registration statement they filed on Form S-3. This means the shares have already been registered with the CC and can be sold relatively quickly. Now, like many filings, we have a section on forward-looking statements. This is where the company talks about potential future events or performance. They use words like believe, anticipate, and expect to indicate these are not guaranteed outcomes. It's basically a disclaimer that the future is uncertain. This section just lists the exhibits that are part of this filing. Here we see the actual sales agreement is attached as Exhibit 1.1. Therese also a legal opinion from Denton's US LLP, which is likely confirming the legality of issuing these shares, and a consent from the law firm. Finally, there is the interactive data file, which makes the filing more accessible. The report is signed by Regular Bhaskar, the Chief Executive Officer, confirming the company's awareness and authorization of this filing. So, what does this all mean for FatPipe and its investors? An ATM offering is a double-edged sword. On one hand, it gives the company a flexible way to raise much needed capital to fund operations, invest in growth, or pursue acquisitions. For a company like FatPipe, especially if they're looking to scale up or weather slow periods, this can be a lifeline. It is a much less disruptive way to raise money compared to a traditional secondary offering, where a large block of shares is sold all at once. However, the flip side is dilution. Every share sold through this ATM program increases the total number of shares outstanding. This means each existing shareholder now owns a smaller piece of the company if the stock price doesn't perform well after these sales, or if the company can't effectively use the new capital to drive growth. Existing shareholders could see their investment value diluted. Looking at the context, FatPipe recently launched a $10 million atmospheres program on top of a $20 million shelf. This means they have access to a total of $30 million through these types of offerings. This suggests they might have significant capital needs or strategic plans ahead. The fact that they had analysts raising price targets and an insider buying shares before this seems to indicate some underlying optimism. But this ATM program is a key development for the near term. Historically, companies that use ATM programs can see their stock price face pressure as shares are continuously sold into the market. For example, we've seen companies utilizing these programs experience a gradual decline in stock value, especially if the market doesn't see immediate positive results from how the capital is spent. Without significant operational improvements or new revenue streams, dilution can certainly weigh down the stock price. In my opinion, this ATM offering allows FatPipe a lot of flexibility to manage its finances and pursue growth opportunities. The risk, as always with these programs, is dilution and whether the company can use the funds effectively to create more value than the dilution itself. What I am actually looking for is how aggressively they deploy this capital and if it translates into meaningful revenue growth or strategic advancements in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.